So, good morning, folks. So, what I wanted to talk to you about a little bit about, we're going to talk a little bit about the market first, and then we're going to lead into self-employment. I want to talk about how we can help folks that are self-employed today get qualified in a very specific way, in a very interesting way, but still allow these people to get an interest rate based on a full documentation loan. And when I say full documentation, there are different types of loans out there. There's what we have, what's called a non-qualifying mortgage and a qualifying mortgage. Non-qualifying is more of your bank statement products where you're not presenting it or you're not giving W-2s, tax returns, pay stubs, whatever it may be. For a self-employed person, of course, it's going to be K-1s, 1120s. Big stack of paperwork, right? When you're doing a bank statement product, all we're doing is qualifying someone on bank statements on their deposits coming in, but you pay to play. So if you're looking for a non-qualifying mortgage, you're not going to get a qualifying mortgage interest rate. So we're going to talk about how we can take a non-qualifying mortgage, turn it into a qualifying mortgage, and take someone from a 5% interest rate on a non-qualifying to a 2.75 interest rate based on today's market on a qualifying mortgage. And this is going to give you a little update on what's happening with the market. Why I wanted to share this is, for me, inflation is a four-letter word. I don't want inflation. Inflation will drive the bond market to increase interest rates. But the feds are still coming in and buying mortgage-backed securities, which is interesting. We've never seen that in our lifetime before. So I want to go ahead and share this with you. Okay, so the summary is that they're trying to keep what the Fed is saying is that we're not seeing an increase in inflation. By what we've actually seen is an inflation increase from 1.5% to basically about 2.5%. That's what the future holds. That's what they're saying. Okay, but the Feds are still coming in and buying mortgage-backed securities. So by them doing that, they're still keeping the interest rates down. But here's the thing, guys: something's got to give. We can't keep buying money with money. And if the Feds are already in debt, and the national debt level we won't even go into, but if you're buying money with money you don't even have, or buying mortgage-backed securities with money that you don't even have, how long do you think that's going to hold? So the reason I say this is because I'm extremely busy, and I'm blessed to be so because of the interest rates. But at the end of the day, this is going to go away. So we've got to jump on when we can, because the only way up right now is the only way up is up, right? Because we're at the bottom. If we can't foresee rates going any lower, or we're going to end up being Canada, and we're going to end up with two programs, and this is all you got, and here's your rate, right? And then I'll be working for a Chase Bank or something along those lines. So anyhow, so with that, we're going to talk about our self-employment. Okay, this is very important to me because the majority of my clients, the majority of the world now, one way or another, is self-employed, whether they know it or not. You have your W-2 position, but hey, then I have my online business. Oh, but I don't count that. Well, absolutely, we need to count that. And if there's funds coming from that account and you are somewhat self-employed, then we want to be able to use that income in a special way to qualify this person, right? Or it's vice versa. They say that they don't have this business, but they have it on their tax returns, and they show a positive through a W-2, but they show a negative through their corporation. Well, guess what, guys? You have negative income if we're trying to qualify you on a full documentation loan, right? Anyhow, all right, so we're going to talk about self-employment versus a full documentation loan. So by taking someone from a self-employment position where we have a negative income and being able to qualify them to a full documentation loan means that someone today can buy on a conventional conforming loan amount in Orange County in Los Angeles up to $842,000. They can buy a property or refinance up to that loan amount and get an interest rate in the twos. Now, how do we do this? So if someone has a self-employment, or if they're self-employed, we can look at their assets. And typically when you're looking at an asset, a bank statement, a retirement account, money market accounts, whatever it may be where they have their money, well, that's an asset, right? That's not income. That's an asset that they use to purchase a property. That's an asset that they use for reserve requirements. But what if we could take that asset and turn it into income? This is interesting. A lot of people, when we're talking about this this topic, they go, "Well, John, that's my money in the bank. How can that be income?" Well, if you take that and you have interest being earned from it, say it's going through a financial planner or it's going through your stock market, anyone can take dividends or they can have interest put into their account, right? And that's money that you've now earned because that's money that's on the market. Does that make sense? So taking it a step further, what if you had your accounts and you have what we call a trust umbrella over it? So what we're going to talk about are trusts. And people have positive and negative when it comes to trust. Mark knows a whole lot about trusts. I highly recommend him. So here it is, guys. If I have a self-employed client and they have not say substantial amount of funds, but they have a good amount of reserves, if we put an umbrella over those accounts and the umbrella is the trust, now those accounts are protected. What they can do with those funds is that if we need a certain amount of money to qualify for a loan, I'm looking at a debt to income ratio and I need an additional $2,000 a month for them to qualify for this loan. And we know that the income is there, but with the write-offs on paper, it's not. So let's say it's $2,000 a month additional income that I need to show for this person to qualify to purchase this home. Their trust account has over 3 years reserves based on that $2,000. What I mean is if they take that transfer, right, they're going to take a transfer and they're going to put that $2,000 into their personal account. Well, 2,000 times 36 months is the amount that we have to show in the trust to support that $2,000, because if it lasts over a 3-year period, it is now Fannie Mae and Freddie Mac guidelines can be considered income. So now I took someone who does have this income, but it doesn't show on their returns because of their write-offs, and now we're able to give them that full documentation interest rate of 2.75 versus trying to come up with a creative way to use their bank statements to qualify a loan. Questions? Everyone's heads are spinning, right? So literally, yeah. So the beauty of the trust, though, and the reason that I recommend a trust is the trust protects what happens with those accounts. A lot of people go, well, why do I have to put my money into a trust? You're not putting money into a trust. The trust is protecting what you already have. And by doing that, no one can tell you what you can do with the funds. We can't force you to keep making these payments after we close on the property, nor can we tell you that you have to keep a certain amount of reserves. Underwriters have crossed emotions and feelings when it comes to these type of programs, but they have to go by the Fannie Mae and Freddie Mac guidelines. So if an underwriter looks at your primary account that's held under the trust and knows that that account will support 3 years of income based on what we're saying that income is going to be taken from that account and into your personal account, we need one transfer. I need to show one transfer. I have to have a trust in place. I have to have a Schedule A to that trust explaining what's happening with this money. And now these folks can qualify for a mortgage, and we're adjusting income for the purpose of qualifying for a mortgage, which used to be a no-no, but under this program, we can do this. So if you know anyone that is self-employed that is having these challenges, which happen a lot, we hear about a lot in my industry, I'm self-employed, I just can't qualify. I tried 2 years ago, I know I can't qualify. I make the money, but I have write-offs, and they're telling me I don't make enough, even though I bring home a substantial amount of money each month. Those are the folks that we want to talk to. This is a life-changing program for people that are looking at purchasing, and it can also be used on refinances. So if you know anyone that is self-employed, I highly recommend that you have them discuss with me, or, well, if they have another mortgage lender, I'll be more than happy to explain how the program works, because I think this is something that needs to be shared. We've had a substantial amount of clients that have been able to close on these programs. They are Fannie Mae and Freddie Mac, and that's a huge thing. They're supported by Fannie Mae and Freddie Mac. That means that Fannie Mae and Freddie will buy these loans. So we know that we're doing a program that is ethical and falls under those guidelines. So again, if you know anyone that is self-employed, please have them come my way. Jon Shrum, making your dream of ownership a reality.